Oh, is your camera off or something?
No.
That's weird when on the
Okay.
live stream your camera is not, or I can't see you on the
What?
live stream.
Why? That's weird.
I don't know. That is weird. Hold on. You know what I'm gonna do? I'm gonna record this just in case because I feel like
Do you have your screen set the right way?
oh, there you are. You just popped
Oh
up.
man, the
I'm wondering
internet's
if
starting to
it's
act
probably
up.
your network, Pansy. It's probably your
Is it a
internet.
delay?
Yeah, slightly, I think. Yeah, that's all right. I'm gonna record this to our computer to my computer, so I'll have this
I'm gonna
recording.
I'm gonna switch my internet service.
Okay.
Oh, okay, hold on. I gotta find it.
We usually have a slow start anyway.
Yeah. Okay, I cannot find it. Oh, there we go. My phone likes to update and move things on me.
Is Chris coming in? Oh yeah, Chris Murray's coming in. Hey, what's up, Chris? Oh, just lost Pansy. Well, we are officially live. Pansy's having some internet issues here.
Hello?
There you go. Hold on. I just lost you, Pansy. I gotta add you back. Hold on.
Ugh,
There you are.
yeah.
That's actually a little bit better. Did you change your internet or did you just change where you were located?
No, I had to change the internet.
Mm, okay.
So
Okay.
it's all good.
Well,
Get it done.
we made it again. Another Friday.
Yes, we did. How are you?
Welcome to the show. How are you, Pansy?
I'm all right. How are you, Justin?
I'm good. We had a good day today.
Yeah, we did. Yes, we did.
And I'll give a shout out to our most current team member, Anna. She did an awesome job today on our team Zoom. And yeah, I'm excited. We've got some stuff going on. So yeah, we're looking forward to that. And so this episode, I named it the Proceed with Caution, the due diligence episode, because I think, Pansy, you and I have been talking about this. I mean, we bring it up every so often anyways, but you and I mean, I know I personally have witnessed many people lose lots of money in real estate, just in investing. Forget real estate, but investing in general, whether it's like lending money, purchasing real estate, what have you. And I mean, I myself have lost money also. And we wanted to do this episode so that we could really kind of shine a light on it. I know I mean, there's stuff all over the place about this. There's even a Facebook group, and you have to be invited to it, but there's a Facebook group that specializes in talking about scams, people getting scammed in real estate, people, you know, having
Yes,
money taken and all kinds of stuff, right?
true.
Obviously, I don't know, that's a little bit of a slippery slope because quite frankly, we're all adults here. And, if you made a bad investment, it's kind of hard to know. It's hard to judge, really where the fault lies.
Yeah.
But that's why we call this the Proceed with Caution episode and do your own due diligence, right?
Yes.
So, the story I wanted to cover on this one, this has been covered kind of a lot, but I don't think people fully appreciate what happened with this story. And I don't know if anybody's familiar. If you are, you can let me know. You can comment, let us know. But there's a guy named Brandon Turner. His name's, you might know him from different names. He's Brandon Turner, Beardy Brandon, the Brandon with the beard from Bigger Pockets. You may not even know who the heck I'm talking about, and that's okay. In 2021, Brandon Turner's fund, Open Door Capital, partnered with Disrupt Equity to purchase I think it was 300, it was like 300 and something, 387 doors, 387 unit apartment complex, which is big. That's definitely big. Um, Called Heights on Katy near Houston, Texas. And the purchase price with closing costs came to around 72 million. That's a big deal. That's going to be probably a class A, class B type purchase. Actually, I think it's probably class A. But they took out a loan of approximately 52 million and raised another 25 million from investors. So operationally, the deal performed well. It actually looked good. Annual rents grew from about 5.9 to 7, roughly almost 8, a 33% increase. Net operating income improved from 2.3 to 3.6 million. Occupancy stayed pretty good throughout that time, about 90% the entire time. And when they sold it, this is the crazy part. When they sold it, occupancy was still good. It was about 95%, which for a 387 unit apartment building, 95% occupancy is very good. I mean, you could run a 387 unit apartment complex at, you know, 80% occupancy and still be profitable depending on how you bought the thing. But this deal wasn't killed by bad operators. This deal was killed by bad financing and bad timing. So the loan was, this is the kicker, and I didn't realize this when I first read about this story, but the loan was a commercial adjustable rate loan with a 4-year term. So they bought a short-term loan, which is, I mean, this happens all the time. This is not unusual. This isn't unusual because they were planning on increasing the value, right? They were planning on, which they did. I mean, they got some value out of it. They increased rents, like I said, to 33% bump in rents. Um, and the plan was to refinance and get their investors out of the deal, into a better longer term note, probably we call it agency debt. So you're in an adjustable rate loan just to get into the property, and the business plan is to increase the value of the property and then refinance and or sell, but most of the time refinance into lower interest, longer term stable debt, right? That's usually the plan. And when you refinance, you're not just refinancing, you're refinancing to pull all of your capital partners or investors money out, give that money, their baseline, the money they originally with you back to them, plus, you know, potentially some interest. Usually it's just to get them their baseline back. And then, you know, you get into a better loan and now you're doing even better. You're cash flowing even more. And at that point, you can give your investors the option of reinvesting with you, staying in as equity partners. There's a number of things you can do at that point, but that's usually the plan. So they had this 30-year, or so they had this short-term 4-year adjustable rate loan. There are two types of investors that were on this deal, Class A investors and Class B investors. And most people, especially new folks, have no clue what that really even means. You can kind of,
I was gonna say, do you want to explain what
yeah,
Class A and Class B investor is?
yes, yep.
Thank you.
So essentially, without getting too much into the weeds, Class A investors are your accredited investors. They're the people that invest first and the most. They get their money back first. Class B investors are, there's usually more of them, but they essentially get their money back second. I'll explain a little bit more here in a minute. But in this particular deal, the Class B investors lost 100% of their invested capital, over $15 million. The reasons the syndicators accepted a loan that would need to be refinanced after only 3 years, or basically 3 to 4 years, right? And they didn't anticipate that the interest rates and the cap rates could rise as quickly as they did. And the investment was too highly leveraged. which made basically refinancing infeasible. By the time they got to year three and they were trying to refinance out of the loan, interest rates had gone too high and the property was already over leveraged. So they couldn't refinance out. So now they're stuck with this adjustable rate mortgage that has now gone up in interest, and cap rates have gone up, meaning the value of the property has gone down. The overall value of the property has gone down because the market cap rates have gone up. And we can talk about that too a little bit, but Brandon handled it. Now, Brandon Turner, think about all these people that invested with this guy. Brandon Turner is one of these people. He's built a very reputable brand. You don't make it to where Brandon Turner got to by losing people $15 million. You don't get there by um, creating bad relationships or creating a bad reputation. You get there, he's got a very public image, talks about very transparently about the deals he does. He's made plenty of people plenty of money. He's a good guy, and nobody involved in this deal at any point was setting out to screw anybody over. And honestly, Brandon handled it absolutely the best way he could have. He was, well, that maybe could be argued, but as far as I'm concerned, from my perspective on the deal, he came out publicly and talked about it. He was not trying to hide anything. Very, very public about it. But he didn't make excuses, right? Instead, he basically took full responsibility. Um, he what was one of the things I'm trying to think of one of the things that he actually said. He basically said that the people that invested in this deal with Brandon Turner, they didn't follow the economy, they followed him. They invested in him, not the deal. They trusted him. So, and these people that invested with him, a lot of the people, they're not experts. They just he was a name, they trusted him. Probably a lot of them been following him for a long time, and they invested their money with him. He even said that he's like they aren't the experts. I'm the expert. This it's my responsibility. But that's all well and good. He can say all of those things, but that's not going to get the other half of the investors their money back. And a lot of those class B investors, I'd be willing to bet a good portion of them could not afford to lose that money. So they followed Brandon, the leader. He said, I chose to buy it. I chose the market. I chose the timing, and I let them down. And again, I really give him props for the way that he handled it. In that the way he came out publicly and got ahead of it and took the responsibility and took the not because this is going to be talked about for a long time, and I don't know if he's ever going to fully live this down. So this is a bad deal. This is a bad situation to be in. It's even worse situation though for the people that lost all that money. Ultimately, the deal wasn't fraud. It was a combination of basically aggressive financing, poor timing, and market conditions that really nobody could have fully predicted. But there
Well,
was some things.
yeah, I would say like when you were talking about it, 4 years adjustable rate on a multifamily,
Yeah. Yep.
that right there was like, what?
Yep.
Like,
Yep.
because even buying our own personal home, learning about the different types of loans, and we were told, don't get into an adjustable loan,
Yeah.
don't get into anything that you're necessarily going to have to immediately want to refinance out of. Like we actually did that with our first loan unintentionally. Like we really did not know we were in an adjustable rate loan.
Oh,
and,
really?
and I think what happened is um after the certain amount of time we were in a certain thing and then it jumped
Hmm.
and we were caught off guard. We didn't realize
Yeah.
that um, that's the type of loan we had
Yep.
because there was so much that happened at the closing table because our lender last minute that we originally had changed their mind or
Yeah.
something like that. And
Yeah.
so we had to go for a different lender. So I'm guessing that's where things got confused and, but either way it happens. But that's to me, that's a red flag on a multifamily, 4 years, adjustable rate. Like, yeah.
That right there. So and this is kind of what I'm getting at here. The investors on this deal who actually did proper due diligence on the loan terms in the capital stack and looking into how this thing was being financed and what the business plan was for this property would have seen and could have seen and actually did, some of them saw the risk profile for this very early on. Now, to be fair to Brandon, the capital stack and loan terms were clearly defined and the risk was mentioned in the contract. Says, listen, there's always a risk in investing. Anytime you lend money or anytime you have a fund, which in this case it was a fund. He had I don't know what reg the fund was, but it was an accredited investor fund, and on the contract it always states this is an investment. Nothing is guaranteed. Investments come with inherent risk, and they did define, they would have had to, the loan terms and the capital stack. They spelled it out in the contract. But regardless of all of that, people see a guy like Brandon, they get excited about the deal because you got to imagine, in this fund, they had plenty of fund calls or, marketing calls to market the deal and explain how amazing this deal is going to be and how much money you're going to make. And what happens is people hear that and their logical brain shuts off and they get excited. And all of the whole like skepticism, due diligence, all that stuff kind of shuts down. They just want to believe that this is going to be great. I trust Brandon, so therefore I don't really need to do any more work. Take my money. And those people got hit. So the credibility trap is people invested because of who Brandon was, who Brandon is, not because of what the deal actually looked like on paper. One investor put in, they said 100,000 after listening to Brandon on the podcast for years and received only $355 total before the deal collapsed.
Oh my.
That is rough. That
Yeah.
is rough. And now I promise you, this person who put in $100,000 probably, now I hope this isn't the case, but probably couldn't afford to lose all of it like that.
Well, accredited investors are accredited for a reason. Usually they have the money to invest. I'm not saying that some of
Yeah.
them aren't like towing the line because you could become a accredited investor with so many, hours of, taking care of your own properties and a certain amount, in your
Hmm.
personal amount, stuff like that. I don't remember all the rules, but I know there's different ways to become an accredited investor
Yeah.
before having adequate money to call yourself accredited.
Well, hold on there. So in order to be an accredited investor, there's a few things that you have to meet. Off the top of my head, I think you have to have at least $1 million in
I don't think
assets
so.
or liquid There's definitely stipulations on how you
There's
become.
definitely a lot of stipulations. I'm just saying that you can ultimately um, get in lesser with putting in the time, right? And
Oh, so okay, right. So, well, in the United States, an accredited investor is an individual or entity permitted to participate in unregistered private securities offerings. To qualify, individuals must meet specific wealth, income, and professional criteria. So you're probably right on sub level there. There's no regulatory board or certification. Investors just simply have to prove they meet the requirements to the issuer. To qualify as an accredited investor, you must meet at least one of the following. Income requirements are the individual must have an annual income over $200,000 for each of the past 2 years, with a reasonable expectation of the same or higher income in the current year. Joint or spouse, if you have a spouse, combined annual income with a spouse or partner exceeding $300,000 for each of the past 2 years, with the same expectation or more the next year. Net worth requirements are you need to have a net worth exceeding 1 million either
oh, there.
individually or
Okay.
jointly with a spouse or partner.
Net worth is, yeah, there you
So the value of
go.
your primary residence, is actually excluded. So your primary residence does not count in that net worth. So, and then professional qualifications, there are some professional qualifications. We don't need to go into too much of that, but that's essentially what you need to be in order to be considered an accredited investor. Now, from my understanding on this deal, the Class B investors on this deal, don't quote me on this. I don't know that all of them were accredited investors. I think the Class A investors got in first, that put in the most, that were essentially got their money out. Those were the ones who got their money back. Those were the accredited. I'm pretty sure those were all the accredited investors. Or either that or they were just like, the people that um the relationships that Brandon had invested with Brandon, many times, or he had relationships with, something like that. Don't quote me on that part. I'm not 100% sure. It doesn't really get into that. At least a lot of the articles that I've written about this don't really get in too much into that part. But here's what I want to know. And by the way, for people who jumped on after, we're talking about the Brandon Turner deal where he lost $15 million of investors' money on a large multifamily deal. And by the way, it did not happen. This didn't happen overnight. This deal it came to fruition in 2021. There was a lot of, time that passed in between when they found the deal versus when they funded it and closed it. And then the operations and the time it took for the cap rates and interest rates to go up, all of that stuff took time. So it didn't happen overnight. But what I want to know is, if you take away Brandon Turner's name off this deal and you just show someone the loan terms, like a 4-year adjustable loan at 72 million for a $72 million property, would people have still invested in it? Like, or did the name just carry the entire deal? I think there's probably a little bit of both there, but I think ultimately a lot of it was his name. And at what point, does trust become a liability in all of this? When any time you're lending money or anytime you're doing any deal, even a deal you're going to buy for yourself, at what point is it that you're trusting in people? When does that become a liability for you? So Brandon actually did. I mean, I don't know how your feeling is about that, Pansy, but
I haven't really paid too much attention, honestly. Like, I
Mhm.
know things are happening. I mean,
Mhm.
he's not the only one, right?
Mhm.
Like, there's been
Definitely not. Definitely
there's
not.
been several things, and like,
Yeah.
it becomes a small world when you get into the real estate
Yeah.
investing world. And so, yeah, I like, you're right. I don't think as many people probably would have invested if he didn't do all of that, right?
Mhm.
But at the same time, I don't believe he did any of it intentionally,
No.
you know.
No, I don't believe that
Um,
either. I don't believe
and I
that either.
believe he does plan on paying people back one way or another, and I hope he does, you know, if he can.
We'll see what happens. I think in this particular case, he's definitely not the only one that this has happened to, that's lost people money like this. He's just the most public profile, so he gets a lot of the attention on a deal like this. Plus, it was a big deal. It's a lot of money to
It
lose.
is. It really.
Um, yeah. I mean, Brandon actually did something most syndicators never really do. He posted about it publicly and took responsibility, which I really give him credit for. But doesn't change how the people who lost their money feel about it, and more importantly, doesn't give those people their money back. Now, I don't know what he plans to do personally about it, or any of that, but essentially, they're kind of out of luck right now. And,
Yeah.
you know,
And that's unfortunately, that is the thing about any type of investing. There's no guarantee, right? Like,
yeah,
we're not guaranteed.
yeah,
Now, ideally, right, the property is supposed to cover your money,
yeah,
ideally,
yeah.
you know.
Well, what really pains me when I look into this deal is that longer term debt, even if it was a little, well, I won't say adjustable, but longer term debt could have saved this deal if they had planned a little bit better and modeled out more of the downside of what they were doing with an adjustable rate loan, maybe they would have come to the agreement or come to the understanding like, hey, maybe a short-term 4-year adjustable rate. Or because think about it, if you can't get out of that loan in 4 years, if anything goes wrong and you cannot refinance out of that loan in 4 years, and you can't, because you're going to be, the note's going to come due. If you can't get out of it in 4 years and refinance out of it, every time you extend that loan, not only are you paying higher interest, but you're also paying extension fees. There's all kinds of costs
Yeah,
that start stacking up. So that's why I look at this deal and I'm like, God, how would they have not like at least talked about that? Like, you
maybe
know,
they did. And
maybe they
some
did.
people were
I don't know.
like, okay. I mean, it happens. Some people are just like, screw it. Let's
Well,
go. And,
yeah, yeah, I think you're right. Well, I think also they just, we're going to refinance out of this thing in 2 to 3 years. Nothing's really going to happen that badly, or we don't predict anything that badly is going to happen in that short amount of time. We see all this upside over here. There's plenty of room to increase the value of the property. There's so many different things, but regardless, here's the key points. Adjustable rate loans in real estate can be deadly when interest rates move, right? And in 2022, they moved faster than almost anyone had predicted. That's another part of this, right? It's just a lot of it, a timing issue. A 4-year loan term on a value add multifamily deal is very aggressive. Most experienced operators prefer 7 to 10 year fixed debt or agency debt. Agency debt just meaning Fannie and Freddie Mae debt. In order to get Fannie and Freddie Mae debt, the property has to be worth more than $1 million
mm,
already. So there's a bunch of stipulations on your ability to get Fannie and Freddie Mae debt, but Fannie and Freddie Mae debt is 5%. I think it's gone up slightly, but it's around 5%. And it's long term, 30 years, right? But longer term debt would have saved this deal. When interest rates doubled and cap rates expanded simultaneously, the property couldn't be refinanced at a level that would return the investor capital. The property sold, but the debt obligation consumed everything. Class B investors got zero. Let's talk about the Class A, Class B really quick, just so everybody's clear on this. When a syndication raises money, and there are typically a couple of different types of classes of investors. Class A investors are usually the preferred equity or senior debt accredited investors that get paid first. Class B investors are what they call the common equity or last in line. So they get all of the upside when things go well, but they absorb the majority of the loss when things go wrong. And in this case, things went very wrong. Most passive investors, including myself, like I wasn't aware of this either until I really started researching this. Most passive investors don't fully understand what class you're even in and what that even means in a downside scenario. So, important to understand these different facets of a deal that you're getting into, whether you're buying it yourself or you're investing, lending somebody money. Um, Here's a question. Most people who invest passively in a syndication don't actually understand what class of investor they are. They just hear 7 to 9% preferred return and they're like, I'm in. And in this case, it's actually higher than that. They hear 11, 12 and up, percent preferred return and they're just like, I'm in. What questions do you think every passive investor should be asking about something like this? Let's talk about just the capital stack, meaning the loan, the financing of the deal before they ever write a check. What do you think the questions should be that they should ask about the deal or about the specifically about the
will
loan?
the tenants cover the mortgage, right? Is it going to cover our expenses?
Yeah,
What's our return, right? Like,
yeah. I
yeah.
mean, here's some questions, okay? And these
I mean,
are
there's a lot of questions.
Yeah. Yeah. I mean, the property actually performed like again, like I said, this deal that Brandon Turner did, the property actually performed operationally. Rents went up 33%, occupancy was 95% when it sold, which is very good for a 387 unit apartment building. The investors still lost everything though, right? The Class B investors lost everything. How does this happen and what does it tell us about where the real risk is in the real estate deal that they did, right? In this case, it was almost entirely the aggressive financing that they got. The market did what it did, but the fact that they were locked into this really aggressive short-term adjustable rate loan on this property was really what killed it.
Yeah. I was gonna say that. I mean, it
Yeah.
sounds like off the bat, it was the financing was the biggest issue.
Yeah. If I'm a first time passive investor, like listening to this podcast or any other that might talk about, because they have done a few other shows about this and dug into this. And by the way, I'm going to put this in the chat right now. I think anybody who wants to know really hear a different perspective on this, go listen to Jamil's breakdown of this. He did a freaking phenomenal job talking about this deal. I'm going to put it in the chat right now. Go check out Jamil's rundown of this deal. It's worth the listen for sure. I liked it. Um, and for anybody listening after the fact, I'll
And
put it
we
in the
can
show
add
notes.
that in the
Yeah, I'll
description of
put
the podcast.
yeah, I'll put it in the show notes. So let's talk about the questions to ask about the financing here. So if you're a passive investor and you're thinking about investing in a deal, let's just talk about it from the lending side for a minute, and then we can talk about like due diligence from the buy side. If you're just talking about lending on a deal, and you want to know how the deal is obviously being operated, who are the operators, but more importantly, what is the debt structure on this deal? In other words, I'm lending you money, sure, you need a certain amount of money for me, whatever. How are you guys buying this deal? Am I funding the whole, down payment? Am I funding the down payment and the capital to fix the property up? Like what is this money and um what does your capital stack look like? Like how are you funding this deal? So, and then we ask that question, they should be able to answer, they should be able to explain to you how they are financing that property and the numbers. Ultimately, they should be able to go through the numbers with you. Uh, my questions would have been on something like this, like, look, what kind of loan are you getting on this property? Is it fixed or adjustable rate? How long is the loan for on this property? Like, how many years is the loan for? And what happens at maturity? Like, what's the strategy? Does it need to be refinanced? What are what are we assuming here is going to happen when this loan comes due? And what is the debt service coverage ratio? But again, the debt service coverage ratio is the difference. It's basically a buffer, right? It's the difference between your net operating income and your debt service. How much of a buffer you have to take care of the debt service, right? How much additional cash are you making from your profitability and your ability to cover that debt service? Um, DSCR lenders look at the debt service coverage ratio pretty heavily. You got to hit a certain number because that tells them like, hey, based on how this property is being operated, based on the income you're making on this property, how much buffer do you have between the money you're making and the cash flow, and are you going to be able to service this debt properly, right? Based on your numbers, your projections of your numbers. In other words, the income and expenses. Uh, are you going to be able to service this debt properly? So and that's a question of most deals like this, multifamily in general. It's 1.25 is the debt service coverage ratio. Let me see if I can explain this a little better because I'm butchering it a little bit, but and you can look this up too, by the way. So, and again, I'm Googling this, but let's see if I can break this down. Debt service coverage ratio is the key financial metric used by lenders, especially DSCR lenders, to measure a borrower's ability to cover their debt payments with their operating income. It compares a company's or property's cash flow to its required principal and interest payments. So it essentially looks at your net operating income. So that's your income after expenses, after all just your normal expenses, insurance, taxes, utilities, all those normal expenses. We're not even talking about your debt. We're just talking about your income from your rent, pet fees, all your income that you're getting on the property minus the normal expenses. That's your net operating income. And you divide that by the total PITI that you're going to be paying over the course of a year. So your total amount that you owe on the debt every year. And that's your DSCR ratio. So DSCR, the for a multifamily, it's 1.25. For I think for single family, you got to at least hit a 1.0. That might actually That might actually be true. But anyway, so the entity generates enough cash flow to pay its current debt obligations. So a DSCR ratio of 1.25, which is what you have to hit for multifamily, and in most cases for any DSCR loan for them to fund you, is just one of the metrics. This indicates that for every $1 of debt that you have to pay, there is $1.25 in income. So that kind of makes it a little bit easier to understand. But so every dollar you got to pay in debt, there's $1.25 in income that you're making. So you've got that buffer to be able to cover that debt. Anyway, so those are questions. Is it adjustable? How long? What happens at maturity? These are all questions you should be asking. Um, I would say question number two is understand like what class of investor am I? Like, do you even know what class of investor you are? Am I preferred equity, common equity, or something else? Like where do I fit into this deal? You know? If something goes terribly wrong on this deal, what happens to my money? And how long does it take to get my money out of it? I would say there's three main questions every lender, anybody who's planning to be a private money lender, private capital partner, or whatever, that you should be asking is how much for how long and my return, what's my return, and what happens if everything goes
Right.
upside down?
How is my money secured?
Yeah. What happens if everything goes wrong? What happens? Where do I fit into this? Um, and what's your plan if everything goes wrong, right? Um, as far as like underwriting goes, because one of the things I didn't necessarily want to do on this particular podcast episode was start going into like into the weeds in underwriting. That's something everybody should understand at a super high level. Something I really like to use a lot of times is the Bigger Pockets calculator. They actually have a pretty comprehensive calculator on the Bigger Pockets website. But if you don't have access to that, um, I mean, this is the age of AI, guys. We can build out simple high level calculators that will look
Or
at
you
just
can use good old pen and paper.
yeah, you can use good old pen and paper. But if you're really serious, even buying property is like that's really the question is just show me the numbers. Show me the numbers. What's the income? What are the expenses? What's the debt service? Like how are we gonna finance it? How much does that cost us every month and then annually every year? How much income are we making every year? And what are our monthly and annual expenses? And if it doesn't add up, if you're negative or you're even like we've had some of our mentors talk about this. It's like, do you think single family real estate? Let's do some like really basic numbers here. You're paying, let's say 2,000 a month in debt to PITI, you're paying 2,000 a month and you're making, let's say 2,100 in rental income. Are you cash flowing? Better yet, actually, I'll go even higher than that. Let's say you're paying 2,000 a month in your debt service or your principal interest, taxes, and insurance. You're paying 2,000 a month, regardless, every month for your mortgage on the property or your loan on the property. And you're making 2,200 a month in rent. Are you cash flowing?
Probably not.
Yeah, probably not. Probably
Probably
not.
because that extra 200 bucks, you probably got to put it towards other things for that
Yeah.
particular building, right?
Yeah.
Like
I mean, you got to think of all the other
expense.
expenses that come with it. And after owning a property for 2 years and doing this and operating it, I can tell you that purchasing the property is just the very beginning. All the expenses start to show up after you own the property. The HOA fees, the utilities, the maintenance, the everything, the insurance, or if you have to get extra insurance, what if you have to pay mortgage insurance? What if you need mortgage insurance because you paid a really low down payment. And so these are all things like all you want to know all of your expenses. And the two biggest things that'll screw up any deal if you don't get these numbers right is your taxes and insurance. You can be, and this is especially true on multifamily RV parks, you can be a little off on some of your other numbers and still be okay. But if you screw up on your calculations for taxes and insurance, that'll kill a deal faster than anything. Um, so those are two very, but ultimately you need to know all of your expenses, what they all are. And if you don't know how to figure out your taxes, um, on a property, the best thing you can do is call the county tax assessor's office and ask them how they calculate taxes. They will tell you. You can literally get on and call them. It's all public information. They should have a public number. You can call for whatever county, call them and ask them how they calculate taxes for whether multifamily or single family. How do you guys? What's your formula for calculating annual taxes? And from there you can figure out what you're going to pay monthly. And it's usually and every county is different. Some counties will determine your taxes based on their biannual assessment of the property. Some counties will determine your tax rate based on the purchase price. So it just depends. Um, in the case of my property in Austin, they do an assessment every 2 years and my tax rate is determined by that assessment. Had nothing to do with the purchase price. It has to do with their assessment of the property. And I get to every year, when they before they do the assessment, they send me in the mail a letter that allows me to contest that assessment if I want to. So they'll tell me on roughly what they're thinking their assessment is going to be, and if I think they're over assessing the value of the property, I can contest that and make a case for them to essentially lower my tax burden, right? Um, so yeah, $200, you think you're cash flowing $200, all it will take is one broken whatever, one, one broken
Heck, a
ref-
broken faucet will cause that
faucet,
kind of.
broken. I mean, literally well, I was want to get too hyperbolic, but if you've got a broken HVAC, if you've got an electrical problem, a plumbing problem, even if, uh, drywall, problem, or maybe I shouldn't say drywall, but mold problem. These things,
Anything major,
yeah,
you're, yeah.
yeah. For the property that I still have a buffer of about $2,500 in a bank account that's sitting in a high yield savings account that earns 4% a year. Now that's not very much. I think it's actually higher than that. It's like 4.5%. It's not very much, right? But it's earning interest and it's just sitting in account. So if something really bad happens, and actually I'm adding to that every month. I put a little bit of money in there every month from the rent, and I'm putting in like $80 or something like that every month. So that money goes up, but if something big happens, I at least have somewhat of a cushion to take care of it, because if I don't have that money there and something happens, we call it a war chest. If I don't have that war chest there and something expensive happens, now I am in the red for the next year to 2 years. And that's really the reality. So anyway, let's look just really high level. Ask about the loan terms, understand what class of investor you are and where you fit into the deal. What's the operator's actual track record? This is another one now with Beardy Brandon. Everybody kind of knows this guy because he's very public. He's done many deals. He's made people plenty of money. So he's got a good track record, right? But you want to know their real track record, not their highlight reel. Yeah, if I go look up Brandon Turner on his YouTube channel, of course he's going to show me all of his successes, right? On his Instagram, he's going to show me all of his successes. I want to know the real track record. How many deals have they actually done of that size? I would have wanted to know that, wouldn't you? Like if I'm
Yeah.
investing in this 387 unit apartment building, how many deals like this one has Brandon and his team done before? Like this one, right? And have any of their deals underperformed or lost investor capital before? Has that ever happened before? Are they the operator or are they physically the ones operating the property? Are they there or someone on their team there operating it? Or are they partnering with somebody who's an operator? One of the deals that my partner and I were looking at, we weren't going to be the operators. We were going to have an arbitrage, a sober living arbitrage come in and operate the property, right? So know if they're operating it, if they're partnering with someone. And in the case of the Heights on Katy in Texas, ODC partnered with Disrupt Equity as the property manager, and Disrupt Equity turned out not to perform as expected. So Disrupt Equity in this case was the operator of the deal. So Brandon, Open Door Capital, that's what ODC stands for, is Open Door Capital. That's Brandon's company, partnered with this Disrupt Equity company, and they turned out to be not a great operator.
Mm.
So that would have been a good question to ask Brandon. Like, so are you operating this, or is like who's operating it? Your partner? What's their track record?
Yeah.
Um, so what are the assumptions in the underwriting? Let's talk about that real quick. These are just, again, we're not going super deep on this, but these are
Yeah,
high,
we're getting close to the end.
yeah.
Holy smokes.
Oh, by the way, if anybody has questions, you can raise your hand and ask, but what's the rent growth you're projecting? What's the cap rate? And anybody who doesn't understand cap rate, you can look it up, but cap rate is a prediction of risk. It's your capitalization rate. Um, oh, our friend actually described this probably one of the better ways I've heard it, but it's essentially how much money uh you're making for every dollar. Well, actually, I'm sorry, that's cash on cash return. Cash on cash return is literally how much you're making back for every dollar that you've invested in the property. Like how much money you put in, what's my return for the money that I put in? Um, oh God, I always butcher this on cap rate, but you can think of cap rate as a prediction of risk. The way it usually works is if a property like a multifamily property where you're using cap rate to help determine what the value of the property is, the more deferred maintenance, the more the property is kind of like in bad condition, the higher risk, right? Because it's going to require more money to get the thing started and get it stabilized. So there's more inherent risk involved, which means the cap rate is going to be higher. In other words, you should expect a higher capitalization rate on that property for taking the amount of risk you're taking. When a property is stabilized and it's well run, this is you looking at a property to buy it is the way I'm explaining this. But you looking to buy a property that's stabilized and is really well run, really well managed, that cap rate is going to be relatively low because it's stable. There's not a lot of
We've
inherent risk.
already done all of the work to
Yeah,
it.
they've already done all the work. So they're going to command a higher value. And there's an inverse relationship with it. But we won't. So the higher the cap rate, I'm sorry. The higher the cap rate, the lower valuation of the property. So the less the property is going to be worth. The lower the cap rate, the higher the value of the property is going to be. And this is from your perspective as a buyer. Okay. So I think to end this off, like there's a lot of ways to look at this, but ultimately just ask for the numbers. And if they can't explain the numbers to you in a way that makes sense to you, if you don't understand it, I think one of the best rules of thumb I've ever heard was if you can't explain a deal to somebody in simple terms, that means you don't understand it well enough and you shouldn't do it. And anytime you're asking the investors and even asking yourself about a property, if you can't answer some very basic questions about the basic numbers on a property, you shouldn't be investing in it. We were looking at a property and we were like trying to figure out every possible way to cut cost on, the renovation budget, which, okay, yeah, you want to save a little bit of cost, but if $800 to fix a window is going to like break the deal, you probably shouldn't be doing it, you know? So that's basically it, guys. So if you guys have any questions, I hope you guys enjoyed this, but I'm
Yeah.
gonna share. I think I already shared the link to Jamil's breakdown of this, but this isn't to scare you. Honestly, I'm not here to scare anybody away from it. This isn't like, hey, maybe I should invest in real estate. Real estate is still one of the greatest wealth building tools ever. But it's not as passive as people want it to be.
Yeah.
And passive investing still requires understanding. Like you still need to understand what you're doing. So proceed with caution doesn't mean don't proceed. It means go with your eyes wide open and ask the questions. Be ready to ask questions. And if at any point the people you're either lending money to or even yourself, you can't answer simple questions about the numbers and the operation of the property, walk away. And another real quick one is if people start getting defensive, this is a big red flag for me now. And it probably should have been a lot sooner, but if people get a little defensive because you're asking these questions, very normal questions about a property and about an investment opportunity, that's a huge red flag. Like, just think about that for a minute. Um, so that's it. If anybody's in a deal right now, I'd love to hear about it. Love to know what your thoughts are. So anybody listening after the fact, comment, let us know what you're doing. And if you have any questions about what we covered. And yeah, appreciate all you. So
Appreciate you. Thank you.
yeah, thanks guys. We'll see you next Friday.